Shares of Netflix on track to end today's session slightly lower after Citi downgraded the stock, citing concerns about revenue outlook for the year. Netflix shares are up more than 50% in the last year and currently sit right around $480, just below Citi's $500 price target. We're joined now by Jason Bazinet, Citi Managing Director. Jason, it is great to have you on the show. So it was interesting, Jason, because you told your clients, listen, it's clear to you, and of course many others, that Netflix really won the streaming wars. They're both profits and scale and poised to be net debt free, but you downgrade the stock, Jason. How come?
Well, it used to be controversial when the stock was 200 a share, whether the ad tier would work, whether Netflix would generate, meaningful amounts of cash flow. And now we're just so squarely in the consensus. And as we looked out over the next 2 years, there's a couple fears. One is, I think in the fourth quarter of this year, street estimates are a bit too high for the top line. Next year, I think content costs are too low. And then third, there's an outside chance that Netflix does something which the market doesn't expect, and that is pursue transformative M&A.
And so presumably you think that that is a low probability at this point?
Yeah, I don't think it's a high probability. The problem is that the consensus has the company generating, $4 billion plus a cash flow, and all of that is being plowed into buybacks, all of it. And so to the extent that Netflix does anything with that cash flow other than buy back stock, you're going to see the free cash flow per share end up being lower than the street estimates.
And I'm curious, just let's say they did really pull the trigger on a big acquisition. What kind of company do you think they could be interested in?
Well, for a couple of years now, Netflix has been nibbling at the edges with small mobile game publishers, right? They want to broaden the portfolio into video streaming and actually get into mobile games and get people to engage with Netflix, outside of just video consumption. They've also talked quite openly about their desire to get more IP to sort of fuel more interesting films and TV shows. And the one area where that all might converge would be a AAA publisher that has both a big mobile game portfolio and, of course, has intellectual property that you could use to make new TV shows or new films.
And so, Jason, are you suggesting then, hey, they may be interested in making a play for a big publicly traded video game publisher, EA, a Take-Two?
Yeah, exactly.
Right, it's interesting.
And so it's one of the things, the question we've gotten from institutional investors is, would that necessarily be bad? What if they paid a decent multiple? What if it ultimately created a lot of shareholder value over the years? My point is that may be true. They may pay a good price. They may create value in the long run. The problem in the near term is that's going to dramatically complicate the narrative, right? If there's one thing that Netflix has, it's a pretty simple narrative. It's a very sort of monolithic business model, right? Sign up customers, get ARPU, sell ads. All of a sudden you throw in there, where are we in the console cycle? How many units are they going to sell of this particular AAA game? Is this mobile game, going to roll over, that maybe did $60 million a year in revenue? It just complicates the story. And usually complexity is not good for multiples.
Okay, so let's assume, as you are, that they're not doing this.
Okay.
At the same time, you've effectively said in your note that they've won the streaming war, right?
Yeah.
So there is a gap, as you say, between the street's perception and the reality of where they're priced right now and what they're capable of. So if they've won, is it just that they are not going to grow at the same rate and the street is assuming that growth is still coming? Yeah.
So, you may recall that Netflix went X growth, right, a few years back, and they've pulled sort of two levers, right? They've cracked down on the password sharing and they've launched the ad tier. And I think the main question that we're getting from institutional investors is, when did both of those, I'll call them product cycles for lack of a better word, run their course? Do they run their course a year from now? Is it 2 years from now? That's the main question that people don't really have a firm answer on. And to be honest with you, we don't either. My only point is, if you look at those consensus numbers, the street is assuming smooth sailing for the next 2 years. And usually in my seat, when I found that nobody wants to own a stock, like Netflix was a couple of years ago, it's time to get constructive. And when everyone agrees that Netflix is the winner and everyone has estimates moving up and to the right and the stock is near an all-time high, that's usually the time to step away. And so that's what we're doing. We're just moving to the sidelines. But it's still a great company, great strategy.
And Jason, as you move to the sidelines here, what are some, just thinking through the upside risks to that call that you see?
Well, we've got roughly Netflix has about 270 million subs. Embedded in our model is about 80 million incremental customers coming from around the globe to the lower priced ad tier. I guess, and I think everyone on the institutional side would agree that the ad tier has been slow to roll out. But that's my big fear, is that the ad tier actually gets more traction and sort of exceeds street estimates, in which case you'd have net ads beat us, beat the street, revenues beat us and beat the street. And that's certainly possible. I just wouldn't put a high probability on that.
So Jason, if Netflix is not the one for 2024, what's the one in streaming for 2024?
Well, I'm sort of drawn to Disney, to be honest with you.
Wow.
And the reason is that if you look at Disney's equity value right now, at $90 a share, the street is essentially paying nothing for their streaming business. Why are they paying nothing for the streaming business? It's roughly 2/3 the size of Netflix, but it doesn't generate any profits. And the street's, sort of mindset at the moment is, if it doesn't generate profits, we're going to value it at zero. What I'm waiting for is a moment, a year from now, 2 years from now, where I begin to get questions from the buy side that says, hey, wait a minute, this Disney streaming business, right? It's 2/3 the size of Netflix. Why are we putting zero value on it? Right? I haven't got that question yet, but to me, that sort of speaks to the opportunity.
And that's the streaming part, Jason. What do you think Bob Iger ultimately does with the linear assets?
Linear's challenging. It's highly cash generative, but I don't think that there's a lot you can do with linear. I think the trick is to sort of manage the degradation in a way where you actually have a place to go. And right now, the way the street looks at Disney is linear is shrinking. There's not a lot to do with it, but the place to go doesn't generate profits. Therefore, it's unexciting. And that's what I'm waiting for it to change. But there's not a lot you can do to change the underlying trajectory of the linear business.
Jason, always love having you on the show. Thank you so much for joining us and helping us think through all things Netflix and Disney. Appreciate it.
Absolutely. Happy to do it. Thank you for the time.